The United States, under the administration of President Donald Trump, is initiating a significant shift in its agricultural landscape for the year 2026. In a move that highlights the ongoing complexity of international trade relations, the administration has overseen a nearly 5% increase in soybean planting acreage, raising the total from 81,200,000 acres to 85 million acres. This expansion comes despite a difficult previous year for corn production, where record-breaking harvests led to a price collapse and significant surplus, forcing a reduction in corn planting by nearly 5% this year. The decision to lean more heavily into soybeans is a calculated risk tied closely to the volatile trade relationship with China. History suggests that soybeans are a primary lever in diplomatic negotiations between the two nations. Last year, a late purchase of 12 million tons of soybeans by China provided essential relief for American farmers and the administration. While China has committed to purchasing 27 million tons annually for the next 2 years, the risk of a renewed trade war remains a concern. Should tensions flare and Chinese markets close, the administration would face immense pressure from its domestic voting base in the agricultural sector. To mitigate this risk, the Trump administration is pivoting toward a secondary strategy: domestic soybean crushing. Rather than exporting raw beans, the plan involves processing them into soybean oil within the United States. This strategy looks toward India, the world's largest importer of soybean oil, which accounts for 60% of global purchases. A recent trade agreement between the United States and India has established a zero-tariff quota for up to 300,000 tons of American soybean oil. This provides a narrow competitive edge over South American rivals like Argentina and Brazil, who typically face much higher tariffs. However, the plan faces steep logistical and economic hurdles. Even with favorable tax treatment, the cost of production in the United States remains higher than in South America. Furthermore, shipping routes from the United States to India are longer and more expensive, as vessels must travel around Africa or through the Suez Canal, adding significant freight costs. In contrast, Argentina remains the dominant force in the market, exporting over 5 million tons annually, while Brazil contributes 1.5 million tons. The most unexpected challenge to this American strategy comes from China itself. In 2025, China began exporting its own processed soybean oil to India at prices significantly lower than those offered by American, Argentine, or Brazilian suppliers. By purchasing inexpensive raw beans from South America and processing them efficiently, China has positioned itself as a price leader that India, a famously price-sensitive market, is unlikely to ignore. Ultimately, the success of the American agricultural expansion may once again depend on Chinese demand. If the global market remains saturated and competitive prices from China persist, the United States may find its new oil processing strategy undermined. This leaves the administration in a familiar position, where the economic well-being of American soybean farmers remains intricately linked to the purchasing decisions of the Chinese government.